Let's talk about silver. And I don't mean the daily chatter, the price noise that distracts so many. We're going to look deeper at a fundamental structural shift that's taking place right now. We're here to find the signal. And that signal points to a growing, and I would argue irreversible split between the paper price you see on a screen and the physical reality of the metal itself. Understanding this is key. So here's our roadmap. We'll start with a critical stress signal that most have overlooked. Then we'll zoom out to the bigger geopolitical picture. After that, we'll break it all down with a framework I call the 4 pillars of reality. This will lead us to a very clear, very logical conclusion. Let's get started. All right, let's begin where the cracks first start to show. There was a recent administrative change. It looked boring, procedural, but to me, it was a flare in the night. It revealed immense stress right at the core of the silver market's architecture. This wasn't routine, not at all. It was a signal of foundational pressure. You have to understand how large established systems operate. When they come under pressure, when their models start to fail, they don't issue a press release admitting they got it wrong. No, they quietly, subtly adjust the rules of the game. This isn't some grand conspiracy. It's just a mechanism for self-preservation. But for those of us watching closely, it tells you everything you need to know about where the weak points are.
So, what was the event? It was an abrupt, almost sudden change to the margin requirements for silver futures contracts. Right as silver's price began to show real, organic strength, the exchange stepped in. The public reason, of course, was risk management, but its strategic purpose was clear: to slam the brakes on momentum by making it much more expensive to play the game.
The mechanics of this are absolutely key. They shifted from a simple fixed dollar margin to a percentage-based margin. Now, what does that really mean? It means that as the price of silver goes up, the amount of capital you need to hold your position automatically goes up with it. It's a powerful, built-in governor designed to fight against any strong price appreciation. And the impact was immediate. We're talking about an increase of thousands of dollars to hold a single contract, literally overnight. This wasn't phased in. It wasn't gentle. It was designed to be a shock, to force a very specific reaction and flush leveraged players out of the market. Now, the intended outcome was obvious: trigger a wave of forced selling, crush the price, and restore order. But that's not what happened. The market's reaction was, well, it was fascinating. All that selling pressure, it was just quietly absorbed, soaked up by a different kind of buyer, one who wasn't using leverage. This tells you the very composition of the market is changing. So this attempt to manage the price, this pressure test, it failed. It showed that the old playbook, the old tools of control, are losing their grip. Why? Because a new force is now in the market. A buyer who is focused on one thing: acquiring the physical metal. This is a profound long-term structural signal. Now, this little event in the silver futures market, it's not happening in a vacuum. It's really a small reflection of a much larger global trend: the division of the world economy into 2 competing spheres of influence. And this geopolitical realignment is having a massive impact on all strategic commodities, but especially on silver. What we're seeing is the silver market literally splitting in 2. You see, in the West, for decades, it's been treated as a financial derivative, something to be traded on paper. But in the East, it's increasingly seen as what it truly is: a strategic industrial material, a cornerstone for national reserves. And this fundamental conflict is shifting the entire balance of power toward the physical side of the equation. You have to listen to the language being used now by governments, by major corporations. It's changing. You hear phrases like supply chain resilience, onshoring, strategic diversification. This isn't just corporate jargon. This is the language of scarcity. When the official conversation shifts from price to secure supply,
You know the system itself is under strain.
And what's driving this? It's silver's absolutely indispensable role in everything that defines the 21st century. Defense, aerospace, green energy, 5G communications. It's not optional. It is a critical input that cannot be easily substituted. This reality is transforming silver from a simple commodity into a piece of strategic national infrastructure. So, to really grasp this new world, we need a new way of looking at it. We need a framework. I use what I call the 4 pillars of reality to cut through the noise and analyze the silver market based on observable facts, not these tired, outdated stories. Our framework is straightforward. Pillar 1, the illusion of price. Pillar 2, the mandate of demand. Pillar 3, the velocity of depletion. And Pillar 4, the architecture of access. These 4 pillars, when you look at them together, give us a clear map of the powerful forces that are reshaping this market right now. Our first pillar is the illusion of price. There is a widening chasm between the paper price of silver quoted on a terminal and the real-world cost to get your hands on the physical metal. That persistent, stubborn premium for physical silver, especially in the East, is telling you something vital. The price on your screen is becoming a less and less reliable indicator of actual value. This price gap creates a very powerful and very logical incentive. It's simple arbitrage. You buy silver at the lower paper price in the West, you take delivery, and then you can use it or sell it where it's truly valued in the East. And the consequence of this is a steady, undeniable drain of physical inventory from Western exchange vaults. The metal is flowing to where real demand lives. The second pillar is what I call the mandate of demand. You have to understand that the nature of demand itself has changed. It's not just about investors versus industry anymore. For a growing slice of the world, major industries, entire nations, acquiring silver is now a mandatory part of their strategic goals. It is not an optional investment decision. And if you look at the demand profile, you see it's increasingly driven by these strategic needs. Industries like solar panels, electric cars, advanced defense systems, they have to have physical silver to operate. Their demand is what we call inelastic. It isn't really dictated by short-term price swings. Procuring silver is simply a non-negotiable cost of doing business. And that's the core difference right there. Speculative demand, well, that's driven by price and emotion. It's optional. But this new mandatory demand is driven by pure necessity. The industries that absolutely need silver to build their products will pay whatever it takes to get it. They don't really care what the spot price is on any given day. Okay, our third pillar, the velocity of depletion. This is about the cold, hard reality of the physical supply. Now, the paper market can create this illusion of endless abundance through leverage and rehypothecation, but the physical vaults, they tell a very different story. The rate at which deliverable silver is walking out the door of these warehouses is picking up speed. And the data from the exchange vaults confirms this. We are seeing a consistent net outflow of millions upon millions of ounces of real, physical, deliverable silver. This is not some temporary blip. It's not an accounting trick. It is a sustained trend of physical metal leaving the system that's supposed to back the paper market. And crucially, it is not coming back. The great irony here is that the very actions taken to manage the paper price are now accelerating the depletion of the physical metal. It's a feedback loop. Every time the paper price is pushed down, it's seen as a discount, a subsidized buying opportunity for the very entities that need the physical product. The tool that was once used for control has now become a catalyst for creating scarcity. And all of this leads us to our final pillar, the architecture of access. This is the subtle but critical pivot from managing price to managing access. You see, as physical supply gets tighter and the old price controls begin to fail, the most important question is no longer what's the price, but rather, can I even get it? This rationing doesn't happen with a big announcement. It's insidious. It starts with things like longer delivery delays, new limits on how much you can purchase, sudden unexplained spikes in premiums. These are all the quiet signals of a supply chain under extreme stress. They're designed to manage a growing shortage without setting off a full-blown panic. This creates a whole new category of risk for investors. It's not just price volatility anymore. It's what I call availability volatility. The real emerging threat is not being able to source physical silver in size when you actually need it. And for anyone holding silver as a true long-term store of wealth, that is a far more terrifying prospect than a drop in the price.
Now, it's really easy to look at all this and just shout manipulation. But honestly, that's a one-dimensional view. It's too simple. And if you stop there, you miss the much deeper, much more important strategic signal of what's really going on beneath the surface.
So the real question we have to ask ourselves is this: are these actions a sign of absolute control, or are they a sign of growing desperation? Are we watching the proactive moves of an all-powerful entity setting the terms, or are we watching the reactive, frantic efforts of a system that is beginning to feel? I believe the evidence points overwhelmingly towards stress. The paper market is simply losing its power to dictate outcomes because it's colliding with the unstoppable force of real physical demand. The old playbook for shaking out speculators, it just doesn't work anymore because the new dominant players are cash buyers who are driven by strategic necessity, not leverage. So when we put all these pillars together, what do we see? We are not just watching another up and down market cycle. No, we are witnessing the very beginning of a great fundamental reconciliation in the silver market, a moment where decades of paper promises must finally come face to face with physical reality. Think of it this way: the paper market and the physical market have been on a collision course for years. A system built on derivatives cannot indefinitely suppress the price of a physical asset when the demand for that asset is real, growing, and inelastic. It's a law of nature. Eventually, something has to break. And this is the single most important strategic takeaway for you. The focus for any serious investor must now shift. It must evolve from asking, "What is today's price?" to asking, "What is my plan for future access?" Because when the ability to source physical silver becomes the market's main concern, the price will ultimately take care of itself. Now, before we conclude, it is absolutely essential to ground the strategic view within the context of your own prudent personal financial planning. Before we depart, remember, the financial landscape is constantly shifting. The insights shared in this analysis are for educational and informational purposes only. They do not constitute financial, investment, or legal advice. Every investor situation is unique, and you should always consult with a certified professional before making any significant financial decisions. Our goal is to help you find the signal, but the final move is always yours. Stay sovereign, stay informed.